I think we have to adapt to it. So clearly we see the impact of climate change. And as you said, last year we had 115 billion losses and the 10-year average is 81 billion. So it's clearly going up, and we see it in perils like floods and wildfires, etc. There's a clear impact of climate change. And there's a certain uncertainty right now about the pricing of that. So this is why some of the capital is quite cautious to come back in. And there's a reluctance to deploy capital because we have to adapt. We have to know the new pricing for all of these risks.
Doesn't that just mean the pricing goes up to tempt that capital back into the business?
Oh, absolutely. I believe in market mechanisms. So what is happening now is prices go up quite a bit. Once people see it's profitable, more capital will come back in.
But what does that do then for those who perhaps need to take that insurance? Because then there is obviously a reaction to both the inflation-related higher costs, the impact of interest rates on just generally the cost of capital, and then, of course, you've got the concerns about having to pay the higher premium.
No, you're absolutely right. But in the end, one of the important things we do for society is giving pricing signals, specific pricing signals. So if people, create houses in floodplains, that's a bad idea, and you can see it in the insurance premium. So over the long term, this is good for society because through these price signals, people will start to build, stronger buildings, will build in the right places, etc. But short term, it's clearly adding to the inflationary pressure.
Yeah. Across the rest of the business, how would you say you are responding to some of the twin challenges that inflation and interest rates present?
Yeah, so this is interesting because both come at the same time in this case, but they're accounted for differently. So inflation, you have to account upfront as much as possible because of existing reserves, and with inflation, you're going to have to pay more for claims. So typically you take all upfront, and companies have started to do that in 22, probably more to come in 23. So there's a big negative at the beginning. Interest rates, as they increase, they go for your investment income, and as you reinvest, it moves up, and that you cannot take upfront. So over the medium term, you're going to see investment income go up, and that's very positive generally for insurance companies.
Yeah. To what extent do you think the inflation rate is going to remain high for some time? Because I guess the risk is that it eats up the gains that you are able to make from increasing prices. Are we, do you think, on the cusp of a rapid deceleration or disinflation at this point, given that some of the headline figures, like the one we just got from Germany, suggest that we're starting to see negative prints on a monthly basis?
Here you see, I think through this whole, I would say, crisis, we tended to be over-optimistic all the time because we don't think this is going to happen again. But yet we see a lot of, if you think about the underlying, there's a lot of inflationary pressures from the world, falling apart to a certain extent, from climate change. There's a lot of these pressures. And so we believe inflation is going to stay at least above policy rates in 23 and 24. So it's longer term. And also the next 10 years, we don't think we'll ever go back to the levels we had before. So I think inflation is a more important topic going forward. Not at the levels we have now, but it's going to be a more important topic.